Welcome to another episode of Market Drill TV. In this very episode, we are going to be looking at Introduction to Crypto Trading Technical Analysis. This is a beginner guide to understanding charts. As you all know, having an in-depth knowledge of technical analysis is very vital to your profiting in any financial market, be it cryptocurrency, Forex, stock market, and any other financial market that has to do with studying the chart and analyzing that very given market. Alright, so in this video we'll be looking at the concept of technical analysis, the importance of technical analysis, dangers of ignoring technical analysis. A lot of people have lost money to the financial market due to their inability to carry out an effective analysis of the market before making their entry. We'll also be looking at the platforms you can use to carry out your technical analysis, understanding the chart. I've discovered that a lot of newbies, the chart looks so strange to them. Let me use that word. But I will be explaining certain things to make you understand what the chart stands for, and we'll also be looking at the different type of chart, anatomy of candlesticks. Understanding the candlestick and what they stand for. We have the bullish and we have the bearish candlestick. What makes a bullish candlestick and what makes a bearish candlestick? We'll also be looking at candlestick formation, and we'll also be looking at chart patterns and indicators. Before we proceed, if you are yet to subscribe to this channel, please kindly hit the subscribe button below, the notification bell beside, so that you'll be the first to be notified whenever I drop a new video. Alright, so on our first outline being the concept of technical analysis. So what is technical analysis? Technical analysis, also known as TA, which stands for T stands for technical, A stands for analysis. It's an in-depth study of trends, chart patterns, candlesticks, volume, general price action, and predicting possible price movement. Now, technical analysis has to do with studying of historical data that has to do with price action in the market. Now, if you don't know where you are coming from, you wouldn't know where you're heading to. So based on price action in the market in the past and in the present, as an analyst, you'll be able to know possible price action that you should expect from the market. Now, it is relevant to all traders, be it day, position, and swing traders, with no exception. Now, if you're a day trader, I previously explained who a day trader is, and position and swing trader. Now, day trader are people that open a position and close it within 24 hours. Position trader, these are people that hold position for a long period of time, while swing trader are those people that trade the trend and all that. Now, technical analysis is very important for all these three classes of traders. Whether be it a day trader, a position trader, or swing trader, you need technical analysis. So don't think because you are a position trader, because you hold for the long term, you will not need technical analysis. You need technical analysis because it will tell you the right time to make your entry or buy into a particular position and hold for the long time if you so wish. Now, without an understanding and practical application of technical analysis, trade activity could be termed as gambling or game of luck. There are people that will just buy into a position or into a coin or into a currency pair without technical analysis. It's just a game of luck. I believe you have to understand technical analysis for you to know best entry for that particular position or that particular pair and best exit for it. Never you buy a coin because it's pumping. Always have your why reason, be it fundamental or technical. Always have your why reason why you should buy into a particular coin. Always have your why reason, be it from a fundamental standpoint or technical standpoint. Now, from a technical standpoint, it might be based on the coin is on a very strong support, or possibly one of the indicators have. So we are going to look at that anyway, or indicators or chart patterns or candlestick formation. Always have your why reason why you should buy into a particular coin. Don't just buy because it's pumping. Don't just FOMO in. Ensure you have your why reason. Alright, so what are the importance of technical analysis? 1. It provides past, present data and information on the activities of traders in the market within a given time frame. Now, from the charts, or for every activities carried out in the market by traders, it is represented on the chart. So in carrying out your technical analysis, you'll be able to get certain information from the chart, and this will help you in taking informed decision. Now secondly, it gives insight of possible future price action. It helps in maximizing profit as trader knows suitable entry and exit point. That is very, very important. Knowing your entry and exit point, it is important to your profiting in any financial market. So you can only know best entry and exit point from your technical analysis. It minimizes risk exposure. It boosts confidence and trade decision. So based on technical analysis, if you don't just go into the market and just buy, but your decision are based on your analysis of the market, it boosts your confidence. Even though if a trade is going against your entry, because of your analysis about that market, you still hold to that position, and at the end of the day you see that the market still retraces or pull back and goes towards the direction of your position. Right, as important as technical analysis may be to a trader in any given market, ignoring technical analysis might also expose a trader to certain dangers. Now, one, we have exposure to high risk as trader does not know suitable entry and exit point. I believe you should understand what entry and exit points are. But if you don't have that basic knowledge of what entry and exit points are, kindly refer to my previous video. Secondly, another danger, inability to track activities of trader within a given market, therefore blind to price action. As I earlier stated in this video, price action and activities of trader are represented on the chart. So there is a need for you as a trader to analyze chart history data and information so as for you to know where the market is possibly heading to, and this will aid in taking informed decision. Thirdly, ignoring technical analysis can also lead to you losing profitable trade opportunities. For you to be a profitable trader, you need to understand the art of technical analysis. You need to understand how to analyze the market before making your entries on trade. So if you ignore technical analysis, there is high tendency of you losing trade opportunity that would have made you tons and tons of money. So here are platforms for technical analysis. We have the TradingView. This very website and application, you can use it for your cryptocurrency technical analysis, forex, stock market, and indices, a lot. We have Coinigi, we have Tap Trader, we have cryptocurrency exchange for people that are strictly cryptocurrency traders. You can carry out your technical analysis on those exchanges like Binance. We have Bybit, we have KuCoin, we have OKX, and etc. A lot of these cryptocurrency exchange platform, they also allow for technical analysis using their chart. All right, we are gradually moving to an important section of today's video, understanding chart. Now, to a newbie, looking at the chart is so confusing, not knowing what to do and all that, but I'll be taking you through basics you need to understand when it comes to the chart. Now, what is the chart? Chart is a graphical representation of price action based on the activities of trader in a market within a given period. Now, this activity can be activities of trader within seconds, minutes, hours, days, weeks, months, and all that. Now, we have types of charts. We have three main types of chart. There are, I think, over 5 types of chart, but we are going to be looking at 3 key types of chart, which are, we have the line chart, we have the OHLC chart, which is open, high, low, and close. That's the meaning of OHLC. We have candlestick chart, is the most used known chart among traders. So let's practically consider these three types of charts. All right, now this is how the candlestick chart looks like. This is how it looks like. As you can see, some green candlestick, red, and price actions and all that. Now the OHLC is also known as the bars, represented by bars. This is how the OHLC charts look like. You can see they did not use candlestick to represent price action within time frame, but bars are being used on the OHLC charts to represent price action. Now let's consider the line chart. Switch to line. Now as you can see, the line chart is entirely different. It's just fluctuation volatility of price action represented using lines. You can see the price going down, it went up, hit resistance, went down to support and all that. So this is the line chart. So you see we have considered the line chart, the candlestick chart, and the OHLC chart represented by bars. So these are the three key types of chart. Now the candlestick chart being the most used chart by most traders, we are going to be laying more emphasis on it. So now if you look at this very chart, you see that this chart is made up of candlesticks. Now some green while some red. Now we'll be heading to the anatomy of a candlestick. So here I'll be explaining why some candlesticks are red and why some are green. Now in every financial market, we have two contending sides, being it the bulls and the bears. Now the primary interest of the bulls is to see that they pushed the price of that very given asset upward or currency pair upward, while the bears, their primary goal is to push the price of a given asset downward. Now looking at these very candlesticks, it has the body, which happens to be this. It has the wick, this thread, which also known as the shadow. Then we have the high and the low, now based on volatility. Now this is the bear. We have the opening and close. This shows that the bears won in this very candlestick. This the opening price, which is higher, and the closing price is lower. That's why this candlestick is red. But I'm going to explain more on the chart. Then we have the highs and we have the lows, and we also have the wick. This thread here is also known as the wick or shadow. So heading back to the chart for more explanation, you can also see the green and the red candlesticks as I earlier mentioned. Now let me zoom so that you see clearly. Now we can see green, red, green, 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 red, green, red. Now for every green candle, it shows that the bulls won for that particular candlestick within that given time frame. Now looking at this very chart, each candlestick represents a day. So this very candlestick shows that at the end of the close of this given market within that very day, that's on the 19th of December 2021, as shown here on the chart, the bulls won here. Now this is the next day, 20th of December 2021. It shows that the bears won as red. Now 21, the bulls won. Look at now for every candlestick represented here, representing a given time frame, it also forms pattern. It also forms pattern which might be bearish or bullish, and we'll be looking at the different type of candlestick pattern. All right, so here are some candlestick formation or patterns. Now we have bearish engulfing. Look at it, which starts with a green candle followed by a large long bearish candle, red candle. Now we have bearish tweezer. Look at it. We have bullish engulfing, which has a preceding red candle followed by a long bullish candle, we have bullish tweezer, we have dodges, we have evening star. You can see the formation: hammer, inverted hammer. We have morning star. You can see the formation of the candlesticks. We have shooting star, we have spinning tops, we have three black crows. You see the red, which is what? A bearish candlestick pattern or formation. We have three side down. Look at it. This is it. This is it. So whenever you see this on the chart, it shows that it's a what? Three side down. We have three side up, which is this. And all these patterns are represented at given time frame on the chart. So if it happens that the candlestick formation pattern is a bullish pattern, is signaling a possibility of an uptrend in price or an increase in price of that particular asset, currency pair, or token that you are trading on, then we have three white soldiers, and this very candlestick formation is represented by three green candlesticks. You see the first one, you see the second one, you see the third. Now for every succeeding candlestick closes higher than the preceding one on these three white soldiers. So as well, so let's look at the chart for the representation of this candlestick formation. All right, so from this very live chart, we can see some of the candlesticks pattern being formed on it. Now, like here, you can see the bearish engulfing. Look at the green candlestick. Look at the long bearish candlestick covering the preceding candlestick, which is what? A bearish engulfing. Now, remember, a bearish engulfing what is a bearish candlestick pattern. So now you see, after this bearish engulfing was formed, what happened next? You wait for a confirmation. If the next candlestick form does not close above this very long bearish distance, then it's more of a confirmation to a possible downtrend in price. So if you look at the chart from this very long candlestick form, the price of this very token started going down and down. Now let's look for another candlestick pattern. Now you can also see here that a bullish harami was formed here at this point, a bullish harami. And after this bullish harami was formed and a confirmation, what happened then? The price of this very pair started going up. You can see it went up. All right, so from around 0.05 it went as high as 0.087. so that's it. Now look at another pattern here. Look at this is a bearish harami here, and what happened next? A confirmation of this candlestick pattern formed. And what happened next? The price went down from around 0.21 down to 0.12. So understanding candlestick patterns also aids in analyzing the market, because for every candlestick form and every candlestick pattern form, it communicates a message. It tells you something about the activities of traders within that given time frame. Now this candlestick price representation can also be in a different time frame. It can be a 1 day. This particular candlestick formation, each candlestick represents a day. Can be 4 hours. You can change it here, which simply means that for each candlestick represent 4 hours. So this is a 4 hours candlestick each. 4 hours candlestick as well. You can change it to 1 hour. So every candlestick here represent an hour. So all this time frame is just to ease your analysis. So you can use different time frame in analyzing the market so as to have a clearer perspective to activities of traders within given time frame. You can also consider some bullish candlestick pattern. We have the hammer, which is represented here, and the potential direction is up. We have the inverse hammer. It is a similar bullish pattern. It is the inverted hammer. The only difference being that the upper wick is longer while the lower wick is shorter. I've earlier mentioned what wicks are and when explaining on the anatomy of the candlestick. So you see the upper wick, this is it, which is longer than the lower wick. This is the inverted word hammer, and the potential direction is up. So whenever you see something of this nature on the chart, you should know that there's a possibility of you seeing an increase or an uptrend in the value or price of that particular asset or currency pair. Then we also have the bullish engulfing. We have the bullish engulfing, which is represented here. The succeeding candlestick is longer than the preceding candlestick, and the succeeding candlestick encloses what the preceding candlestick. The potential is up. We have the piercing line, which is this is the candlestick representation. We have the morning star. This is how the morning star looks like, representation of the morning star, and the potential direction is up. Three white soldiers, I've earlier talked about this. We have the hanging man. Here the direction is down. Whenever you see this, the direction is down. Possibility of you seeing a decline. Shooting star. This is a shooting star. Bearish engulfing. Remember we talked about bullish engulfing. So in bullish engulfing, the succeeding candlesticks is what? Green. But in the bearish engulfing, the succeeding candlestick is red. As the candlestick that succeeds the previous candlestick is red in bearish engulfing. So you can see it here that this succeeding candlestick is red and it is longer than the preceding. It encloses the preceding candlestick. We have evening star. You can see it here. This evening star, the direction is down. So whenever you see this kind of formation of candlestick on your chart, there is a possible potential decline in price. Then we have three black crows. This is it. And we have dark cloud cover. This is it. And we have a number of it. So you can also make more research so as to gain more information on this. But I believe with this, at least you have an idea of the candlestick formation. All right, so we are now in chart patterns. Now we have two main types of patterns. We have the bullish pattern and we have the bearish pattern. Now under the bullish pattern, we have a pattern like the double bottom, we have the ascending triangle, we have the copper handle, we have the asymmetric triangle, we have the bull flag, and there have you. So you can see the representation of different chart patterns here. This is a double top, a bearish. This is a head and shoulder, a bearish. We have the rising wedge, is a bearish pattern. We have the double bottom, a bullish pattern. We have the inverse head and shoulder. This is a bullish pattern. We have the falling wedge, is a bullish pattern, and all that. Now this very pattern, as you see represented on this very slide, you also come across them on your chart. So it is left to you to do your due diligence so as to know your entry, because even from this very pictorial representation, you can see the entry point, the stop loss, and the target. So when trading using chart patterns structures as a trader, you should ensure you look out for chart patterns, because formation of chart pattern, be it bearish or bullish, has an implication on the direction of the market. So whenever a bearish chart pattern is being formed, that shows, or that gives you a signal of a possible downtrend in price. And whenever a bullish chart pattern is formed, that give you a signal for a possible uptrend in price. So you should ensure you look out for these chart patterns. Look at them here, look at them here. But let me go to my chart so that I can show you some of these chart patterns represented on the chart. All right, so let's take a look at some of these chart patterns represented on this chart. Now, this is a BTC USDT chart on a 4-hour time frame. Now, from here you can see a double top. You can see a double top. See the first top. See the second top. Let me zoom it. This is a double top. Now you can see the first top. This look at the second top. And now double top is what? A bearish chart pattern. And what happened after the formation of this double top? The price of BTC went down from 37,700. Sorry, it went down from 39,400. You can see it, down to $30,000. $30,000. So that's a double top pattern. Now let's look for another chart pattern here. Now here is another chart pattern. We have the ascending triangle. You can see it, ascending triangle. And what happened? The price kept on going up until after the break of this very channel, before we had a change of trend. Now we also have let us see. We also have a formation of a head and shoulder pattern here. Look at the first shoulder, look at the head, look at the second shoulder formed, and this is what a bearish chart pattern. So whenever you see this chart pattern, know very well that the price of that particular currency pair is about to go down. This is a bearish chart pattern. Now we also have what? A falling wedge here. You can see a falling wedge, a falling wedge. This is a support and this is a resistance of the falling wedge, and the falling wedge is a bullish pattern. So but if you look at this very falling wedge, what will confirm a reversal of price back upward is when this falling wedge is being broken upward. But in this very case, let me zoom it, the falling wedge was broken downward. You can see it here, it broke downward. So this is a retest of the falling wedge. Look at it, you see it broke downward. So that means this channel failed to hold, and what happened next? The price went down. Though this channel, this very pattern is a bullish chart pattern, being the falling wedge, but it broke downward instead of breaking upward. So it has terminated whatsoever formation or chart pattern formed here. So it does not hold, meaning that it broke downward. If it happens that it broke upward, that means it's a confirmation that there is a possible price reversal upward. So that's some of the chart pattern. Let's see whether there is any other. There are a number of it, but this is just few as seen on the chart. We have come a long way. In this very section, we'll be looking at major indicators. So we have the RSI, which is the relative strength index. We have the EMA, which is the exponential moving average, and we have the MACD, moving average, convergent, divergent. We have a number of indicators, but we'll just be looking at these three indicators. All right, so let's go to our chart. All right, so firstly, what is relative strength index now? The relative strength index, which is the RSI, is a momentum indicator used in technical analysis that measure the magnitude of recent price changes to evaluate overbought or oversold condition in the price of a stock or asset, cryptocurrency, currency pair, and all that. Now, that's it, a basic explanation of what the relative strength index is. Now let's go to our chart. Now this is a BTC USDT chart. So now for you to pull out your indicator on the chart using trading view, just click on indicator here, then type RSI. So you can see it here, the relative strength index. Click it. Alright, so it has been added to the chart. So now this is your RSI. Now if you look at the RSI, it flows with the chart. Now this, if the RSI goes above 70, that means it is overbought, and if it goes below 30, that is oversold. So whenever the RSI goes above 70, whenever it goes above 70, shows that that particular asset, that currency pair, it has been overbought by traders in that particular market. So it is not advisable to go into the market at an overbought state. Now look at it. If you look at the chart here, overbought, you see that from this very region the price started tanking, started going down. You can see that. Now looking at it from here, oversold region, what happened? The price over here started going up. You can see it here, started going up from oversold. Look at oversold, it started going up. You can see it, the price oversold here and the RSI started going up. And look at it, oversold here and the chart started going up as well. So it flows with the chart, with the candlesticks. So now look at it here, the price of BTC started going down here, and look at it here, it's showing you on the chart that it's almost at the overbought region. So whenever the RSI is overbought, it is not advisable to buy into, except if you are trading futures or you want to short the market. Then possibly you might short the market if other indicators or chart patterns aligns to what the RSI is telling you. Then you can decide, after doing your due diligence, to short the market or to sell off. Now if you look at this very place, you see that it is oversold here and it is oversold here. So what happens next? Look at it here, it went down, but before you knew it, it started going up. So you can buy at oversold region, sell at overbought region. That's the RSI indicator to chart, to trade the market. Oh, secondly, we have the exponential moving average indicator. That's the EMA. It is a technical chart indicator that tracks the price of an investment over time. The EMA is a type of weighted moving average that gives more weighting or importance to recent price data. Now let's go to our chart. Now let me take off the RSI since we are done with RSI. For you to add your EMA, simply click on indicator at the top bar here, then search for exponential moving average. So look at it here, you then click and wait for it to be added to your chart. Alright, it has been added to our chart. Now you can see our exponential moving average, though it's not too clear. So let's edit the colors. Alright, so the first exponential moving average, that's the length, it should be 20, while the second should be 55. The EMA should be 55. Alright, then the style, the first EMA, that's the 20, should be yellow, while the 55 should be red. Then you click on click on OK. Now I believe it's more visible now. Now if you are to use the exponential moving average EMA 20 and 55 to trade any given financial market. Now this is the idea behind using the EMA. Now remember, the yellow EMA is your 20 EMA, while the red is your 55 EMA. So whenever the price or the candlestick goes above the yellow EMA and retests the yellow EMA, it gives you a signal of a possible reversal of price upward. Then whenever the EMA breaks below the red EMA, that's the 55 EMA, and the red EMA stays at the top while the yellow 20 EMA stays at the bottom, that shows a signal of a sell-off. Now look at it here. When the 20 EMA crosses the 55 EMA and retest the 20 EMA, the price sold off. You can see from here it sold off down to this very place. And when the 20 EMA crosses the 55 EMA and start trading above the 20 EMA, what happened next? We saw the price of bitcoins went up. So you can see it went up, trading above this 20 EMA. And you can also see a cross of this 20 EMA which goes below the 55 EMA, and we had a sell-off. So the primary idea is whenever the price crosses, or whenever the 20 EMA crosses the 55 EMA, which is the red one, whenever the yellow EMA crosses the red EMA and the candlestick is above the yellow EMA, it indicates a possible reversal of price upward. Then whenever the red EMA crosses the yellow EMA and the red EMA stays above the yellow EMA and the candlestick is below the 20 and 55 EMA, that shows a possible sell-off. So you should follow it in that manner. Whenever it goes above the 20 EMA, the yellow EMA, and trades above that 20 EMA, it shows an indication of what? A possible uptrend. And whenever the yellow EMA crosses the red EMA and the candlestick is below the 20 and 55 EMA, it indicates a possible downtrend. So you just follow it in that order, and that will ease your trading. So you can also use primarily the indicators to trade the market if you so wish and all that. So you can see it here, it crosses above the 20 EMA and we saw the price going up. When the 20 EMA went below and the candlestick went below, we saw the price go down. So here it crosses back, you see it. So you see here the 55 EMA has been at the top of the 20 EMA, and from the 67 K dollar mark of BTC, we have seen BTC gone down to around the 37K dollar mark. So that's it for that when it comes to EMA. I know very well that you have gotten a lot of value from this very video. If you have any question, please kindly drop it in the comment section below. If you are yet to subscribe to this channel, please kindly hit the subscribe button and the bell by the side so that whenever I make educational video like this, you'll be the first to be notified. Thank you. Bye for now.